Well, mostly lower day in markets on Tuesday, with the exception of wheat. Chip Nellinger, Blue Reef Agri-Marketing, joining us. And Chip, it felt like a risk-off day for sure.
Yeah, it was very much risk off. This latest Federal Reserve interest rate decision really wasn't what they did. They left it unchanged, but it's what they said. They said, we're going to keep interest rates higher for longer. They've been saying that for 18 months, so I don't know why that shocked the market all of a sudden. They also said we're going to raise it at least one, if not two more times in the next 6 to 9 months. And that really kept a lot of buying interest on the dollar. It kept our interest rates really rocketing higher. And that's created kind of this risk-off environment as there's fears now that the economy is finally going to slow and the consumer really gets drugged down as well in this environment.
And of course, that's hurt cattle. It's hurt the soybean market. And let's talk about soybeans specifically, because are we also seeing harvest pressure there, concerns about the river adding insult to injury?
Yeah, for sure. That is really kind of a perfect storm. You've got this risk-off mentality. The funds have been long beans, so they're getting out of their bean position at the end of September, at the end of the quarter. Now it looks like they're continuing liquidating that long position at the beginning of October with the new quarter. On top of that, it does look like there's a couple of rain shower chances here, like Wednesday, Thursday in the upper Midwest, but we got a pretty clear 7 to 10 day window. So it's kind of the gut slot of harvest. Unfortunately, it's also coming at the low point of the Mississippi River levels, and that's really imploded basis. So it's kind of the perfect storm, what you don't want to see. We've got a risk-off mentality. We've got Mississippi River issues. We've got imploding basis. We've got pretty good yields in the Eastern Corn Belt on these early beans. And it's just kind of a case of wrong place, wrong time for this bean market, and the funds are running for the exit now.
Yeah, they are. And technically, where do you see us finding the next support? How much technical damage have we done?
Well, we've done quite a bit of technical damage. And to top that off, last week, you kind of had a 2 or 3 day pattern, what looks like a bear flag. Not only that, you kind of retested a trend line that we broke through to the downside, and that accelerated the selling pressure. You could really, see another 30 cents, 40 cents. That gets us to a 62% retracement level of the entire move that we started a few months ago. If that gives way, as crazy as this sounds, you could be right at $12, maybe a touch under. Now, I'm not saying you're going to see that, but if it's a full-out liquidation mode by the funds and they want to get it out entirely of their long position and maybe get a little bit short, you could put a 12 in front of this thing and maybe an 11 in front of it before the selling abates. Now, all that being said, I think you could rush back and, see $13 again sometime this winter. But right now we're in the midst of this kind of perfect storm I talked about. Outside market influence, risk off, and then this Mississippi River basis implosion is really a bad deal for the bean market right now.
So corn on Tuesday saw a little spillover from the negativity in the soybean market, but really the last few weeks has held up like a champ. Do you think the harvest low is in?
I kind of do. Now, again, I'm hoping that beans don't go $1 lower. If beans do go $1 lower, it's not going to do the corn market any favors, but it's kind of a different scenario, right? If we're into this risk-off mentality, the funds have a massive short position built up in corn and wheat. So if we're going to see the funds want to come to the sidelines and just get out of positions, then that could mean that we're going to see some buying interest in wheat and corn and some more selling interest in beans. And you could have a period of time here where these spreads go a little bit haywire, where you could see corn and wheat go up, beans go lower, really press these spreads a little bit as well. So to answer your question in a long roundabout way, I kind of do think and have thought for 2 or 3 weeks now that we've seen the harvest low. You're on that point on the calendar where we typically have seen it by now. Really, it's today, right? It's October 3rd on a long-term seasonal where we mark the harvest low. So I really think that there's a strong possibility that you've seen the harvest low. The October 12th crop report is going to confirm that, especially if yields are unchanged to lower. I think that's another argument that we've seen the lows.
Yeah, and some of it also depends on whether the wheat market has bottomed. So we scored new contract lows in Chicago wheat on Friday, and now we've had China coming in and buying. Is that what gave us the boost, or are funds now covering their short positions, or both, or what?
I think a little bit of both, and I think this, hopefully this announcement of China buying U.S. wheat, right? That kind of came out of nowhere a little bit, but maybe that's the final indication that U.S. wheat prices have dropped low enough to kind of uncover some demand and get to a level that starts stimulating that demand. So if that's the case and funds are in risk off or profit taking mode, that is probably a good combination to maybe say, yes, maybe Friday was the low in the wheat market. We are going to get a crop report, and that's going to be helpful for the market on the 12th. But if China's in here buying, it might strongly indicate that we've dropped far enough to stimulate some demand and maybe mark a longer term bottom in the wheat market. And to your point, if that's going to be the case, that's going to spill over and help the corn market as well.
Are we low enough in all of these markets now in the grains where you think we are competitive or not?
Well, that's going to be the question. I think as you get deeper into harvest, we should start seeing both corn and bean exports pick up a little bit. Just seasonally, that's when that seems to happen. Now, the Mississippi River situation is going to maybe skew that a little bit because we're not going to be able to get the all the grain shipped out of here. But I do think that we're at a price level. And the market action in corn kind of hints at that, right? We've tried 4 or 5 pushes into the bottom end of the range here the last 3 weeks, and it's kind of met with some good buying. So to me, I think that the market action is telling you in corn that we're at a fair fundamental value. I think the purchase by China of wheat this morning tells you that maybe wheat has finally reached a fundamental value. The only thing I question, I'm not sure that beans have found that value yet, though.
So the risk off macroeconomic concerns obviously have been hitting the cattle market, did so again here today. And now we have taken out some pretty key support, haven't we?
You really have. And you're closing under some, key moving averages for the first time in a long time in both live cattle and feeder cattle. So I think it's an important rest of the week here. First week of a new quarter. The funds have been really making a lot of money for the better part of 2 years, being long both feeders and live cattle and adding on every break. And so the outside markets to me this week feel a little different. It feels a little panicky in bond yields. It's feeling real toppy in the equities. And there's such a strong correlation to the equity market and live cattle, even though, it's not perfect. The idea there is, if the equity markets are going lower, then the consumer is doing worse in the pocketbook and going to have less money to spend on beef. Whatever the excuse is, if we close this week on a poor note and we continue to see losses into Friday, I think that really could be something that spurs the funds out of their longs. They don't care about the bullishness, and there are still bullish fundamentals in cattle, but the funds have a massive long position in the feeders and the fats, and if their trend systems kick them out of their longs, it doesn't matter what the fundamentals are. So I think this week is a critically important week technically on the charts for the cattle complex.
How worried are you about what the markets are telling us about the economy?
Fairly worried, right? I'm fairly worried. I've been worried for a couple months that this would be how the end comes in cattle. It always comes, whether you're talking about the bull market in 2012 and it's a drought in the grains, whatever the situation is, the most bullish fundamentals always happen at the top, and it tops before you realize all the bullishness. And so the cattle market still has some bullishness. We still have tight numbers out there. The box beef has started to bottom. Packers, I think, have laid back and trying to extend their kills a little bit here and try to talk the market lower. So there's still bullishness out there, but the equity markets and the consumer spending has been so strong longer than I expected. It feels to me like we're running out of gas on this thing. And crude oil's had a $7, $8 break, $9 break off the highs, but it's just an extra tax out there. I know I'm in one of the high gas states in Illinois, but it's still $3.50 a gallon to fill your car up. And so I'm really concerned, to your point, about demand going forward domestically, and the exports for a month and a half have showed that maybe we're at a high enough price level and maybe a strong enough dollar that we're starting to skew the demand, on the export side as well. So I think it's a real concern out there.
Let's finish up on hogs. We're still feeling the hangover of the hogs and pigs report, it looks like.
They sure are. They sure are. They tried to rally, and they were acting really well. Kind of a counter-seasonal type of a rally. I think we came into September and the first part of October with too much of a discount in the deferreds. Then we have the hogs and pigs report last week, and that really kind of threw a monkey wrench in things, right? That the farrowings number, pigs per litter number, was just massively high for the second quarter in a row, and some of the different classes of weights were on the high side of expectations too. So that certainly needed the market to readjust a little bit. We've seen that, but I don't think there's any immunity there in hogs, even though we are at a lower level relative to beef prices. I don't think that the hog market's immune to some of this fun selling if you're going to see this risk-off mentality for the first half or the entirety of October.
Yeah, and the funds are long in both cattle and hogs, so hopefully it won't get too ugly here. All right, thanks for joining us, Chip Nellinger, Blue Reef Agri-Marketing. That is Markets Now.